Last week was a crazy week in the markets. We saw lots of movement. It was more to do with the earnings and the market responding to earnings. That really was a big driver last week. And we had some big heavyweights reporting earnings. And, there's a real debate what was going on in the markets last week about AI, about, is it producing the results that we need? And that was being played out with what was happening. So we'll talk a little bit about that. We'll take a look at the breadth of the market. It was really weak last week. It was very, very narrow, and what the implications might be for that as well. We'll take a look at what's happening in the month of November coming up. Here we are at the start of the month. What can we expect? I'll take a look at what the top sectors have been historically on average. A little bit later on as well. So let's start by taking a look at the performance last week with the different sectors of the market here. We can see that in this case here, we got the S&P 500 up 0.7% last week. Technology was the big winner here, and consumer discretionary sector. And this was all Amazon, really, to be honest. Amazon pushed that sector up substantially after reporting earnings on Thursday. If we take a look at two other sectors were nominally positive, industrials and energy, but look at all the sectors that were negative last week. All the defenses were negative. Energy, well, just slightly positive. Then we had financials were also down. We're going to talk a little bit about what's going on there. There's some funny stuff happening in that sector as well. So really narrow breadth. Okay, so this is the same sector chart. But this is the sectors relative to the S&P 500 on a daily basis, each day last week, Monday, Tuesday, etc. So when the line's moving up, that means the sector's outperforming the S&P 500. And this black line is the S&P 500 right here. There's only two sectors that outperformed, as we saw in the graph previously, technology and consumer discretionary. Look at consumer discretionary. It was way down here before the open on Friday, and then it popped up here and closed a little bit higher for the week, and everything else underperformed. But what I want to point out here is look what was happening with earnings. We saw big, huge adjustments downwards and downwards again, downwards, etc., underperforming. And the same thing here, even we saw some underperformance. Obviously, consumer discretionary is a little bit different. These are lines relative to the S&P 500. So we saw a lot of movement last week after hours, really driving the market. And then once the market opened, we saw fairly flat relative to the S&P 500 for the different sectors. Very interesting week. This week coming up, it's a very busy week for earnings, but we don't have the same really big heavy hitters that reported last week. And if we take a look here, here's the NASDAQ last week. And naturally, if technology is up so much that you would expect that to do quite well. Small caps. So this was not a risk-on move last week. This was a really narrow market. Otherwise, we'd see better performance from small caps. TSX was down slightly, as well as China as well. So overall, it wasn't really a risk-on move. It was more about the markets really piling into the one sector, really trying to ride that technology AI wave. It'll be interesting to see how long that can last. If we take a look at some of those different sectors, here's gold was down last week, as well as gold miners. Now gold had this strong run, stumbling a little bit here. The big question is it peak or pause? And I think right now it's showing signs of more of a pause. So that's exactly what's taken place in this secular bull run here. We've seen it rally, consolidate for a while, rally, consolidate for a while. We might be in a mini consolidation phase here at this level here. We do start the next strong seasonal period for gold just in a matter of a few weeks coming up in December. So we could just see a little bit of a temporary pause here, or maybe even starts earlier than that. Gold miners were also slightly negative last week. Interesting to see metals and mining down here. It's a stealth bull market for so long. We're seeing a little bit of movement away from that sector recently. This was the standout here. This is the uranium sector. And this really was the result of the deal between the U.S. government and Cameco and Brookfield for $80 billion for nuclear reactors. And that moved that market up substantially. Now, that's the way this sector works. We are in the strong seasonal period. We don't know when these things are going to happen, but when they happen, they can really move this sector up a lot. And so it's very difficult to anticipate that. And if we take a look at the Canadian stock market, TSX, technology was up slightly. Energy was up as well. So it's also the result towards the end of the week. We saw more and more rumors about the U.S. Launching some sort of attack on Venezuela. They basically have an armada off the coast of Venezuela. It'd be very unusual for them to move that much stuff, military stuff, down that way and not do anything. So there could be something coming up. Now, it's interesting because if the U.S. did attack Venezuela, in the short term, there'd be a war premium on oil because they'd be disrupting the flow. Venezuela currently produces about 1 million barrels a day. But if the U.S. did go in and actually gain control over the oil resources, I'm not talking politics here, but I'm just saying if this did happen, they could bump that production up to 4 to 5 million barrels a day, and it's heavy oil. So it's similar to the Canadian oil, actually. Differences, of course, but that would actually be bearish for oil. So we're in this interesting situation taking place, and I guess a lot of that would be how fast could the U.S. actually move that on stream. Last week, we saw the Bank of Canada come out and reduce its overnight rate down to 2.25%. That's getting really low. The Federal Reserve also reduced its target rate last week down to 4%, so reduced it by 25 basis points as expected. But what was not expected was Powell's very hawkish speech. He basically came out and said that the rate meeting on December the 10th, same day as the Canadian actually as well, people should not expect the rate to be cut on that day. It's not a foregone conclusion. And he came back and said, we need to be careful here. In fact, there was one governor that actually said we shouldn't be cutting at all. So, investors were really hoping for this very dovish Federal Reserve, but this isn't really what's playing out at this point. And so that was a little bit of a surprise to the market. Now, the market still managed to do okay because they're focusing on other things last week. But we can see here, this graph here shows the expectations for the terminal rate. So that's the rate where the Federal Reserve is going to end up. So in this article, they actually talk about the neutral rate as well as the terminal rate. And there's slightly different things, but some people say they should be the same. The point is that what we're seeing is the expectations in October for the Federal Reserve to stop cutting at 3%. So it's actually going up. The rate's actually increasing. So they're expecting less cuts. So here's the U.S. on this side. Here's the rate, 4% currently. And this shows the different meetings here all the way down. And I'm going to compare this in a second to Canada. And the first 4 dates coming up are all double dates for Canada and the U.S. So they got double dates. Kind of cool. We don't usually see that happen for so many times in a row. So it'll be 5 times altogether. But if you take a look here, the number of cuts for the U.S., so December, it's 0.67% that they cut as expected. So the probability is that they're going to cut rates. But if you go all the way down here, that's the number of cuts in this case. And we're expecting over the year to be 3 cuts. So before the meeting last week, it was 4 cuts. It's adjusted to 3 cuts. So you can see that investors are expecting the Federal Reserve to actually be less dovish than they were a week ago. Now, if we compare that to what's going on in Canada, so Canada has a different problem. Canada's rate is 2.25%. How low can they go? They can't just keep cutting. And I think investors have this false perception. They think when the U.S. is going to keep cutting, the Canada is going to keep following along. And that's a very difficult scenario because Canada cut a lot more when the U.S. didn't. And now the U.S. is playing catch up. Because Canada can't go too low. They need to save themselves some buffer room if the economy actually starts to show consistent slow growth, etc. And Macklem knows that. And so if we take a look here, the expectations are, if we actually take a look, really no cut next meeting, no cut the following meeting, no cut all the way down, no cut 1 year out. And you can see it actually goes like this, actually, as well. But we're looking at, for the next year, bad news for Canadians expecting cuts because the expectations right now are there will be no cuts. Just as a quick note here, we saw the European Central Bank here last week. It held its rate at 2%. It's got the same problem as Canada. It's down low. They just can't keep going. Otherwise, when things really stumble, if you're already down to half a percentage point, what do you take it negative? No, you don't want to do that because that really wrecks the system, as we saw with some countries, including Europe, during COVID. Last week, we saw the report in Canada. We saw the report come out that the GDP month over month and the year over year. So the survey was for the month over month to be flat. It was actually negative. So we saw GDP go down, negative. And year over year, we saw the expectations 0.9 came at 0.7. So it was lower on both expectations last week, which is not good. And don't forget the quarter over quarter report came in at 1.6% negative for the GDP for Canada. So the Canadian economy is stumbling at this point, and there's a lot of uncertainty. We've seen policies that really haven't supported business growth in the past, and businesses are having trouble committing to the Canadian economy at this point, and there's still a lot of uncertainty on a go-forward basis here. Okay, so let's take a look at some of the earnings that came out last week. Here's Chipotle. I want to start with Chipotle. They came out with earnings. They were down 16% after hours when they came out with a warning at their meeting. It was actually down more the next day, just a huge drop here. But they said a couple things. What they basically said was that their economy is terrible, their words, for anybody below the age of 60. Yeah, so the boomers are okay. Go figure. And they take a look and they say, well, look, our household income, our target market, 40% are below household income of $100,000. So this is, they're dealing with the bottom half anyhow of the income earners here. And they're saying people just can't afford to eat out. This is getting absolutely ridiculous. At the same time, we're seeing travel still doing okay, although that could change coming up. But we're seeing a lot of the high-end ticket items still doing okay. But the bottom end of the spectrum is really, really struggling. So it could be just this segment, the restaurant segment, too, having trouble, of course. But there's other indications as well. But look at Wendy's. I just wanted to bring this up as a reference point. And relative to the S&P 500, this is not good. So they're struggling as well. And if we take a look at quick service restaurants here, really flat for the last few years, underperforming the S&P 500 again. So this sector really has been doing very poorly. They're all suffering from the same problem, basically. Here's McDonald's. McDonald's actually comes out with earnings this week. They've actually done slightly better. You can see here that, a little bit of an up here, and then out we go. So it was actually at this time of the year, summer into August, that we saw this ramp up here. But overall, relative to the S&P 500, they have also been underperforming. So I think this is going to be a really interesting earnings coming out this week. Here's the sector relative to this restaurant subsector relative to the S&P 500. You have to go back to 2009. So this is relative to the S&P 500, not absolute, but we have come back here quite a ways. So it's not just restaurants, though. I mean, here's the Kraft Heinz CEO warns of worst consumer sentiment in decades. These are consumer staple products, and this is not a light warning to say it's the worst consumer sentiment in decades. So once again, we're seeing spending in certain areas not holding up at all, and other parts of the market still doing okay. Okay, so let's take a look at some of the tech company earnings last week a little bit. We won't spend too long on it, but really the big question was with some of these tech companies and hyperscalers is they're demanding a lot of money, they're investing in each other, they're saying they need more money, and et cetera, et cetera. And the question is this actually paying off? That bottom line. And, of course, they'll tell you it is, and they need more. But investors are really worried and saying they don't want to have a moment, which has happened in the past, with Meta, by the way, with the metaverse, is, hey, we need a lot more money, and things aren't going well, and then the stock just craters. And that was a big signal at the time. We saw that really affect the markets. That didn't happen last week. Yes, Meta came out with, once again, hey, we need more money, and the stock did go down, actually. They were one of the few companies that we did see go down last week, and it did scare the market because that was earlier in the week, and they said, oh, here we go again. Because there is some worry about, are the tech companies actually putting this money to work, and for companies to actually make money down the road? Because if they're not making money, then they won't pay for it, basically. And so there's going to be some mismatches. Just like the market doesn't go up in a straight line, there'll be some mismatches with the technology and adoption, et cetera, et cetera. And investors are worried, are we at that phase now? Versus the very long-term picture, yes, AI is going to change the world. Last week, we saw Apple come out and saying that their ad business has done extremely well. It set a record. I mean, nobody was really talking about that, but still a notable milestone. Apple also came out and said that they are seeing strong holiday outlook, fueled by iPhone release. I mean, usually the iPhone release, they don't have in the last couple of years, they really haven't done very much for the company, but for some reason, this phone seems to be being picked up a little bit. I don't know why. There's not huge differences between this phone and the last phone so much, but the consumers are picking it up. On Thursday, we saw Amazon come out with some strong earnings. We saw the anticipation for that to be quite strong for the company to open up on Friday. And now a lot of this for Amazon wasn't so much the strength of the consumer, though. It was about the cloud business again. And so, yes, they're cutting jobs as they automate. And we don't know how much of that is really because automation versus slowing, etc. But the focus really was on the whole cloud AWS side of things last week as well. I saw this graph for Amazon for free cash flow, if you take a look here. And you can see that the cash flow has just been going down. Now, I have to tell you, so where's it going? It's going to CapEx, of course. And so it's just a trying time. Now, Amazon's done this in the past. If you remember many years ago when it was growing fast, it just didn't care about cash flow. It kept saying, hey, we're just going to pile our money back into our business. And we've seen a lot of this take place. We've seen, in this case here, we see Microsoft stock rises 4% after OpenAI deal with a stake valued at $135 billion. It's been getting very difficult to figure out who's investing in who and who's paying who, how much, and why. It's actually getting quite complicated. This is a graph from Bloomberg. It's getting old because here they got NVIDIA at 4.5 trillion. NVIDIA is actually 5 trillion right now. Yeah, wow. And if you take a look here, but this shows some of the relationships at the time with all these companies giving each other money back and forth. You can see it's a two-way street. Now, sometimes it's not necessarily money, it's equipment, et cetera, et cetera. And how's it being transacted, really? Is it, if I pay you, give you so much money, does that show up in your revenue statement? And if you do the same, so it's like a double counting? It's getting hard to figure out as far as this goes. And this has happened last week again. We're seeing this going back and forth. And some investors are worried that perhaps there's so much money here right now, they don't know what to do with it. So let's all buy into each other for the future. Maybe. It's just an interesting situation. Okay, here's one for the Canadians. We saw MDA actually take quite a big hit. That was the next day, actually, as well. And before that, it was down 7.2%. And MDA took this hit because Starlink was buying out a customer of MDA, and that was having an impact. So we saw that company, which has actually done well over the last while because it's low orbit satellites, which is a prime space, is in high demand at this time. Okay, so last week I talked about Blue Owl. This was actually I said, look, Blue Owl hoots. And I talked about Blue Owl reporting on Thursday, and it'd be important to follow up with that earnings report. So let's take a quick look. Okay, the stock underperformed. Market didn't like what they saw, but I want to point this out to you here. You can see here that this Blue Owl has been moving lower. This is absolute. This is not relative to the S&P 500. Here's the left shoulder for you technical people. Here's the head, and here's the right shoulder. And there is the neckline. And so it could be breaking down. A lot of people follow that indicator. If it breaks down here, the stock could see some further erosion. This space is actually in trouble a little bit. We keep seeing more and more cockroaches, as Jamie Dimon says, with this whole private equity side and all the financings that are very opaque in there. And so even last week, we saw a few issues. Last week, we saw a couple of issues come out on the distress side. In this case here, it was with Palisades Center Mall. Some of these actually are AAA rated that have actually been getting hit here. So it's kind of interesting. And but we are starting to see some stress hit in some of the real estate sectors. Some of the private equity as well is also having trouble. And it's starting to show some stress because initially it's like, oh, is this just a one-off or two-off? There's a little bit of fraud here, but we're seeing more and more issues here. Not to go too deep into the plumbing, but we did see the repo facility. So that's where the banks go in and borrow money from the Federal Reserve, basically pledge assets overnight basis and take the money out. And you can see here that they've actually been reversing. They've actually been depositing. That's all the green with the Federal Reserve. And we've seen recently an uptick in borrowing, which could be showing some stress in the financial system as the financial reserves comes down. That's one of the reasons why Powell is stopping quantitative tightening. Yes, they've been quantitative tightening for $5 billion a month for the last while. They're stopping that December the 1st. And investors are wondering, is this starting to show some concerns with the system? So far, Yeah, there's some flags flashing, but nothing too serious at this point. On a bigger picture here, you can see the reverse repo. Here it's being used with a deposit of the last few years. And all of a sudden we're running to this situation now where they're actually borrowing money. So that's one of the reasons why we're seeing the financial sector underperform. So this market really is becoming a little bit sector dependent. You really have to watch where you're in this market because some sectors are performing very poorly. And we've seen the financial sector underperform for the while because we've seen this part of the financial sector showing some stress. And here's a scary graph from David Rosenberg, Rosenberg Research. He specializes in scary graphs. And if you take a look at this, is a total share of the population in economic expansion. Like what percentage of the population is actually expanding? So doing better, basically. I think the graph should be flipped the other way on the axis here, but you can see here that really there's only 20% of the population here doing better. That's it, 20%. And what this is saying is more and more people are struggling. And that's what we've seen here really is this line here. And it's just starting to show up in some of the metrics. That's why the Kraft Heinz CEO came out, made his comments, and Chipotle is showing trouble, et cetera, because so many people are starting to struggle here. So the consumer parts of the market are having some trouble. On a positive note, last week we did see the U.S. and China sort of at least patch over. I mean, I don't think we ever really get anything firm with these guys. Patch over their trade deal, sort of come to an agreement on the rare earth metals or elements. But, this could fall apart. I mean, this happened before, back in June, I think it was. They had this deal and it's gone away, it's come back. Look, I don't really trust this situation long term. Both parties at this time are saying, well, you need me and I need you right now. But I think if they can see hope on the other side where they could break away, either party would do that. So right now, but it is good news overall for the market. Just a quick plug, I was on BNN Market Call last week on Tuesday, October 28th, answering questions on the market and talking about what was taking place in the market. If you wanted to check that out, it's on their website and also on their YouTube channel as well. Okay, so let's take a look at what we can expect from economic reports this week in Canada. The U.S. really, it still has the same government shutdown, so let's spend time on Canada here. Right now, the expectations for the unemployment rate, which is the big one on Friday, is for it to go up from 7.1 to 7.2%, and the number of employment is to decrease. In other words, job losses, 2,500 job losses. Now, I have to warn you here, so 60,000 to minus 2.5. The Canadian numbers tend to be very lumpy, and it's really hard to see. You really need to see a trend, but we're not really seeing strength in Canada at this point, nevertheless. But, the negative number is not a good number. We have seen it bounce around here a little bit, so I wouldn't read too much into just one negative number here at this point. Okay, so let's take a look. This is actually from my Thackeray's 2024 Investor's Guide. This is November, what to expect. And we're taking a look at long-term sector trends, 1990 to 2022. Information technology tends to be the top performing sector. Yeah, I can see that. This is the time of year where they tend to do well. I want to talk about this sector here, the industrial sector, which actually has the highest frequency of success of outperforming the S&P 500. So these sectors are ranked in order of gain for the month on average in this time period. But 76% is actually a very strong number. And the industrial sector is the one part of the market that's actually showing some strength. So if you had to break it down to three parts, the growth sectors, the cyclical sectors, and the defensive sectors are lagging. I'll go into that a little bit more. So consumer staples, even utilities is lagging. Some of the cyclicals are also lagging at this point as well. Except for, I'd say the industrial sector is showing more strength than others as well. So this being strong on a seasonal basis is good at this time. So right now, information technology, I think as long as the information technology sector is performing well, this market is robust. It's when the sectors, if it does turn down, that will be a problem. But November tends to be strong for the sector. Materials has not performed as strong as industrials. It doesn't have that same strength. Mainly made up of chemicals in the U.S., so it's a little bit different. This is really benefiting from the build-out, promises of build-out for infrastructure, etc. Consumer discretionary. Now, That sector really last week was propped up by one company, as I said, Amazon, which is a big part of that. Tesla and Amazon make up, I think it's around 44% of that sector on a cap-weighted basis. So, but watch out. There's, as we discussed, the retail part, the restaurant part is not doing well. Healthcare. So here we are. This is actually a defensive sector, 55% of the time. And what you'll find is this sector will outperform in times where the market doesn't do well in October. So it actually is an okay seasonal period for the healthcare sector in the month of November as a hedge against the market not performing well. And especially if the market continues to get narrow. So I think the healthcare sector could do quite well. Consumer staples has just been lagging like crazy. It typically does well in October, did not do well at all. Financials is showing a total underperformance trend, continuing to head lower. Telecom isn't really performing that well. Energy is bouncing around a little bit, showing pockets of strength, but really is not outperforming. Utilities, now this one here you have to watch too, because sometimes it can play off as a beta trade because of the AI power demand setup, but on a seasonal basis, this is not the sector to be in. As far as the seasonal trends go, it's only outperformed the S&P 500 30% of the time in the month of November. If we take a look at earnings coming out this week, lots and lots of earnings, busy week. Monday after the bell, we got Palantir coming out. So the momentum players will be definitely watching that for sure. Shopify on Tuesday morning, particularly for the Canadians. Uber, I want to see what's happening with Uber here. Pfizer as well. If we take a look after the bell, we got AMD coming out. Some good companies coming out, but not the big, huge heavyweights. Definitely want to take a look on Wednesday morning before the bell at McDonald's to see what's happening. We talked about that part of the market not performing well. On Wednesday after the bell, a whole host of companies coming out all the way down. On Thursday, we've got, in this case, Airbnb. This is going to be an interesting one to see what's happening in that sector because they've had some regulatory issues, and I'd like to see what they're saying about travel demand as well, to see if it's going down, because it's been okay for the demand side up until now with air flights and TSA gates and stuff like that, but I'm starting to see a little bit of weakness. And on Friday, we have Constellation coming out, KKR, Enbridge for the Canadians here. We got Duke Energy as well, Brookfield. So TELUS, once again, for the Canadians. So we got a lot of companies, busy week for earnings. Not a lot of economic reports coming out this week, particularly in the U.S. So it's going to be earnings. Earnings have been good so far. They've been solid. And, companies are getting hit when they come out with weaker earnings than expected. But right now, we're seeing strong performance from companies with earnings. So we are in that stronger seasonal period still. Sometimes after a strong month, the market might pivot for a bit and head the other direction. So I wouldn't be surprised to see a little bit of weakness in early November, but the seasonal trend for the market to do well this time is actually quite strong. Thank you very much for joining me today. If you like this video, please click the like button and please consider subscribing to the channel so you get regular updates. Thank you very much.